The history of gas and oil prices is fascinating and often surprising. Gas prices frequently become political lightning rods because they're extremely volatile and tied to global events. Most recently, tensions and conflict with Iran disrupted oil markets, causing gas prices to spike sharply. Supporters of the approach argued that temporary high prices were worth it due to strategic reasons. Critics called it a costly mistake that would hurt American drivers. As tensions eased and oil prices dropped quickly, gas prices followed more slowly. But why? Why is this? Is this just normal supply and demand? Are people driving less? Or is oil more suddenly available? Oil markets don't behave exactly the way you might think, so let's break this down. First, let's take a quick look at an economics lesson called elasticity. Imagine a rubber band. Some stretch easily with little force, which is highly elastic, while others barely budge even when pulled hard, that is, inelastic. In economics, elasticity measures how responsive one variable is to a change in another. The most common one we discuss with gasoline is the price elasticity of demand. How much does the quantity of gas people buy change when the price changes? Let's look at it this way. If something is elastic, quantity demanded changes a lot when prices change, aka people are very sensitive. Inelastic means quantity demanded barely changes when price changes. People keep buying something roughly at the same amount. Gasoline is relatively inelastic in the short term, but we're going to take a look at this a little bit later and explain. People still need to drive to get to work, to school, and run errands. There aren't quick substitutes, and that's why prices can spike during disruptions without demand absolutely collapsing. So let's take a look at the recent events in the Strait of Hormuz because this is very important when it comes to understanding gas prices, as this is a great example. The recent Iran conflict affected global oil markets because the Strait of Hormuz is a critical choke point. About 20% of the world's supply flows through it. Even though the US gets very little of its own oil through there, we are a top oil global producer and exporter, with most imports coming from Canada or Mexico, but global prices still rose because oil is traded on a world market. This is why US gas prices jumped even though the domestic production is strong. Americans burn through an enormous amount of gasoline. Think about this. Around 137 billion gallons of gas every year is used by American drivers. That's around 375 million gallons every day. That adds up to hundreds of billions of dollars annually. So with such high demand, you might expect prices to stay sky high. But perspective matters here. Let's take a look at the history of gasoline prices because it helps us understand and put this picture into the frame. In the late 1970s, during the Iranian Revolution and oil shocks, gas prices hit around $1.35 to $1.50 per gallon. Now, you might not think that's a lot of money, but if you adjust it for inflation, you could be looking around today's price of $7 per gallon. Right now, the national average sits around $4 or so per gallon as of late June 2026, even after the recent spike. Now, we're not paying $8 to $10 per gallon despite decades of population, economic, and inflation growth. That's partly because of better fuel efficiency, more alternatives, and strong US production. So then one question comes up next. Oil companies, are they screwing us? Well, oil companies do make huge profits, sure. Crude oil feeds many products beyond gasoline. Think plastics, chemicals, chapstick, and other things. Higher prices boost margins in the short run. But the market does have self-correcting forces. Think of this. If gas prices were sitting at $8 per gallon in the long term, eventually consumers would adapt, buying more fuel-efficient cars, maybe EV cars, carpooling, slowing down long vacations, or maybe even being more efficient on errands during the day. Demand would eventually fall, pressuring prices to come back down. Now, it's important to realize here, Americans are remarkably resilient and innovative, especially when costs rise. Now, this system isn't perfect. Geopolitics, refining capacities, regulations, and global events all complicate pure supply and demand. But overall, the US benefits from a relatively free domestic market and massive energy productions. We may blame politicians, and sure, there are times when politicians, the US president, whoever it might be, may see a skyrocketing of prices, but things usually settle down. Understanding the economics of gasoline matters because your choices, what you buy, how you drive, they matter. They influence the market more than you might think. Thanks so much for watching this video, and keep an eye out on more economics explained through Freedom Finances.